Good Saturday morning to everybody, and welcome to Mortgage Matters Radio Show with Rob Weinberg. I am Gary Byron. Hey, Rob, good morning.
Good morning, Gary. How are you?
Great. How have you been?
Very good.
All right. How was your week?
It was, it started out slow, and then I don't know what happened, but things just heated up, and suddenly I had just tons of inquiries from people refinancing and buying homes, and usually this can be a slower time of year. So I was really surprised by that.
Yeah, I'll bet. Busy. It's great to be busy when it's a slow time of year.
Yeah, it was definitely a blessing. And I think it just speaks to the market and what's going on right now and all the opportunities out there.
Well, yeah. I mean, everybody's talking about the housing market right now. And, of course, when you talk the housing market, that goes hand in hand with obtaining mortgages. All the more reason to chat with you, my friend. What I wanted to talk about this morning was adjustable rate mortgages.
Sounds good.
All right. So can you explain a little bit how an adjustable rate mortgage works?
Sure. So an adjustable rate mortgage, we'll also refer to it as an ARM or an ARM mortgage, which stands for adjustable rate mortgage. And it's also known as a variable rate, so it can fluctuate. And the way that it works is you get an initial fixed period, can be anywhere from 1 year to 10 years. And during that fixed period, the rate and the payment will not fluctuate. So after that period, that's when, as we'll talk about, it gets a little bit dicey, and that's when the variable and the adjustments start happening. Normally, they adjust once per year. So I've never really had a client take an adjustable rate mortgage that plans to stay in it forever. It's definitely a very short-term loan, like I said, anywhere from 1 to 10 years. And when it starts adjusting, that typically once a year, it adjusts based off of an index. There's different indexes that it could be tied to. And those indexes are always changing based on the price of credit. So as rates go up, typically those indexes will go up, which again is what can make these a little bit of a more risky play for a mortgage versus the fixed rates that we normally focus on the show and that I typically use more often with my clients.
What are some of the main advantages of an adjustable rate mortgage?
So the biggest advantage would be that normally an adjustable rate mortgage is going to have a lower interest rate than a long-term fixed rate mortgage, which ends up meaning that you're going to get a lower monthly payment. And especially for first-time or repeat home buyers, that means basically more ability to buy more home, more buying power, because your payment can be lower for the same amount by having that lower interest rate. So that's a huge advantage. I would say the other thing is that there are some good flexibilities with an adjustable rate because you can choose whether you want a 1-year adjustable or a 3-year. I would say the most common are 3, 5, and 10-year adjustables. There's also a 7-year that can be attractive. So based on your financial goals and how long you're going to keep that mortgage, you can customize it a little bit. Obviously, the lower amount of time that it's going to be fixed is typically going to be the lower interest rate. But if you know you're only going to keep a property for 3, 4, 5 years, it can be a great way to lower that monthly payment and, stay within your financial goals.
But I would think most people are looking for the 30-year mortgage, all right?
So an adjustable rate is based off of a 30-year amortization schedule. Okay. The adjustable part just refers to the interest rate fluctuation. They're always going to be based off of a 30-year term or a 360-month amortization table. But like I said, after that initial fixed period, the rate can fluctuate. Now, there is an advantage to that because people that took these adjustable rates back in like 2008, 9, and 10, they really hit the jackpot because as rates have trended down, their payments have actually gone down. So that's something a lot of people don't think about, and it's normally not the protocol that you would go off of on a mortgage, but there's a lot of people that took those adjustable rates at that time, and they haven't refinanced yet because they've seen their payments actually decrease. I had a client that took an adjustable rate of like 3.9% way back like 10, 11 years ago, and they took like a 5-year adjustable rate, and their rate has been going down over the years. They're like, why would I refinance? My rate's now 2.8%. It started out at the 3.9, and over the years it's gradually gone down to where now they're paying only a 2.8% interest rate. So it can be a great thing, but that's one side of the coin. What about the flip side where the rates go up? And that's more typical in this economy, that the rates will go up. I think we've had this period of time where the rates have been downtrending for so long. People forget what it's like to be in that rising rate environment.
Well, so what are some of the main disadvantages then of an adjustable rate home loan?
There's a lot of risk when you're taking an adjustable rate home loan. I mean, you're taking all the risk. The bank doesn't have the risk on that because you're the one that has to make that monthly payment. So the number one disadvantage is that it's risky and you could get caught unable to refinance. This was really common, I saw back during the last housing boom in the early 2000s, that people would take these adjustable rates. Back then, we offered a lot of 2-year and 3-year adjustable mortgages. And it was just this temporary thing. But what we found was at the end of that timeline, or in that timeline, people had credit issues that came up. Maybe they missed a payment on something. All of a sudden, their credit score plummeted. Now they couldn't refinance when they really wanted to. Job loss. I had people that took these loans and had a certain job situation, and then they either switched jobs to something where they weren't making as much, or they had a complete loss of a job. Now, when they went to go convert that adjustable to a fixed rate, they didn't qualify for a mortgage. Now they're stuck with that adjustable rate. And there were a lot of foreclosures caused by that, which is why so many people have this taboo feeling about those adjustable rate mortgages, because there's just so much risk there. And the last thing I would say, as far as the riskiness, is what are home values going to be in 2, 5, 10 years? Well, nobody knows. And what ended up happening was people refinanced or took these loans while the housing market was doing very well, while the housing market was on an upswing, and while the home values were skyrocketing. And in their head, they thought, well, my house has gone up 20% in the last couple years. There's no way it's going to go down. It'll at least stay steady and go up. We all know what happened in that 2005, 2006 timeline. So people took these big mortgages out with these adjustable rates. And then even if their credit was fine and their income was okay, their home value had gone down 20, 30, sometimes even 50% loss of home value. Well, how are you going to refinance when you owe more on the house than it's worth? And that's what ended up happening with a lot of these adjustable rates. And there's probably a lot of people that took those loans back then that swore that off and said, I'm never going to put myself in that position again.
I've always heard you never go with the variable rate.
And that's a saying that really came out of that housing crisis, because so many people took those adjustable rates because they were such great low rates and so enticing.
Yeah, but if it's variable, it doesn't stay that way, right? It can be adjusted.
It will be adjusted at some point. So the idea is you want to get out of that by either selling or refinancing before the adjustment starts happening. And that's where these risks come in, because what if you can't because of these factors we talked about, credit, income, or the loss of home value? And the other thing that's a big negative or disadvantage when it comes to these adjustable rate mortgages is unpredictability of interest rates. So if you keep that loan, what is your rate going to be in a year, in 5 years, in 10 years? Nobody knows. So the negative is, what if you start out at a 3.5% rate for 5 years, and then at the end of that 5 years, the rates are 5% or 6%. All of a sudden, you could see your mortgage payment going up dramatically. I mean, hundreds, maybe even thousands of dollars a month, depending on how much you owe. So it's just a really big unpredictability. But like we talked about, it can go both ways. If the rates are going down, you might feel like you hit the jackpot. Wow, my mortgage just went down $200 in a month. Anybody would love that, but that's very rare. And just because that's been the situation in the last few years with a low rate environment, as we're starting to see with rates increasing, inflation increasing significantly, this can be a huge risk. What is inflation and what are rates going to be in a couple years? We don't know, but history tells us they will probably be higher than they are today, which is why if you're going to look at an adjustable rate mortgage, number one, you want to make sure you've got a really good advisor guiding you not only now but into the future. And number two, know the risks and be prepared for them. Make sure that's part of your financial plan.
Why? I guess you just kind of answered that. I was wondering why adjustable rates, have been have popular over the last several years. Why haven't they been?
Right. So, I mean, I think the number one reason is what you said. There's a lot of taboo. Most people know somebody that got one of these mortgages or heard a story about somebody that took one of these adjustable rate mortgages in the early 2000s and ended up foreclosing on their home. Their mortgage payment went up substantially. They had to sell the home. There's a lot of horror stories around these adjustable rates. So I'd say that's one reason why they haven't been as popular. But surprisingly, a lot of the high net worth clients I work with use these adjustable rates a lot more often than others, probably partially because they can have that wherewithal with their income and savings. If their mortgage payment went up, they'd be able to take the blow, so to speak. But I would say in the last 2 to 3 years, adjustable rates haven't been very popular at all. I've probably done less than 5 adjustable rate loans in the last 36 months because the fixed rates are so similar. Why expose yourself to that risk? I'll give you an example. Like if I can give you a 30-year fixed mortgage at 3%, then why would you take an adjustable rate mortgage at 2.8%? There's not enough of a disparity. There's not enough of a difference. Back in the old days when I did these, the fixed rate would be, let's say, 4.5%, and the adjustable rate would be 3.5%. Now, that's a nice differential. Now it's like, okay, taking that adjustable, my mortgage payment could be a few $100s less a month, where it makes sense. At this point, if I told you with the risk we're talking about, yeah, your rate's going to be lower, but it's only going to be $30 a month less or $40 a month less in mortgage payment. Is that really worth the risk?
No.
So that's why a lot of the higher net worth individuals, the people that are dealing with very large mortgages, $500,000 plus, $1 million plus, they use these adjustables a lot because even though it may only be a small differential, when you're talking about many hundreds of thousands or millions of dollars, even 0.25% or 3/8 of a point could mean many hundreds of dollars a month different. That's why it's more popular for them than just the average Joe out there.
Are there banks that only offer one and not the other? I shouldn't even say banks, lenders.
Are there lenders? Not now. I don't know lenders that really only offer adjustable rates nowadays. There's usually at least an option to have a fixed rate and an adjustable rate. There were quite a bit of periods of time recently where I didn't even see adjustable rates at all offered because, again, there wasn't a market for it. A lot of this has to do with the economy and the yield spreads and the different indexes that we're talking about. And when there was an inverted yield spread going on, meaning that, the rates basically, in layman's terms, there wasn't that advantage that we're talking about to take the adjustable rate. Well, why would you take an adjustable if it was higher than the fixed? Yeah. That might sound crazy. That happened. And when that happened, there was no market. Why would anyone do that? So they went out of vogue for a bit. But now as rates are starting to increase and people are looking for that competitive advantage in the housing market, specifically with the lower monthly payment when they're going to pay more for a house, these adjustable rates are starting to become a little bit more enticing. And I think they're going to continue to do that, as we'll discuss.
I know you don't have a crystal ball. It would be, but of course, everybody's wondering. It's not a matter of if it's going to if things are going to change. It's a matter of when. When are things going to change? When going from a seller's market to a buyer's market, or if it'll just level, and I'm sure the interest rates will adjust accordingly, right?
I think that the interest rates will adjust really regardless.
Okay.
I think that's kind of a leading factor on that, meaning rates will go up and then the housing market will start to cool, or buyers will get out of the market because the house that was a $1,500 payment is now a $1,600 payment. So now they have to get a lower price in order to get that same affordability. You see? So, that's one of the reasons why rates rise. That's one of the reasons why the Fed raises interest rates on treasuries and things, is because they don't want the housing market to overheat, or they want to sustain this affordability. So by raising rates, it makes it so that home prices don't go out of control. That's one of the main tools that the Fed uses. So I think we're going to see the rates. It's not going to be something that overnight you wake up and the rates are higher. This is something that happens slowly and gradually, and we're starting to see it. We've already started to see the rates are off of the all-time lows that they were at the end of 2020, early 2021. They're starting to come off of that. They have come off of that a bit. They're still very good. They're still historically very low, but if you were looking for the lowest rate of all time, or of your lifetime, you probably missed the boat on that. You can still get something very similar, though. Like, we're talking about within a quarter or 3/8 of a point of the all-time lows, which is phenomenal. So there's no way to know what, like you said, a crystal ball, what's going to happen. But I think that this time around, the housing market is more sustainable. People aren't taking these adjustable mortgages as much just to get a house. They're not getting zero down loans. Most people are putting a good down payment. Those are the issues, Gary, that were really causing that overheated housing market and that crash that we saw back many years ago.
Yeah. So then what are some refinancing strategies around adjustable rate mortgages then?
So adjustable rate mortgages can be great for people that feel like their income or know that they're starting a career or going to be on a path where their income is going to increase. Something that I see that really common with is doctors and attorneys that are just out of school or are starting a new career, a new profession. Right when you start, you're not making the big money, right? You got to really get seasoned and work your way up the ladder. So adjustable rates can be great for that person to get in the door on a home with a really low payment and then know that 5 years from now, there's a very good probability that they're going to be making more money. So even if their mortgage did go up a couple $100 a month, they'd be able to still afford the home. That's one spot where it can really be a great thing. And around refinancing, it's really the same type of idea that, get that low payment, save as much as you can while your budget may be a little tighter or while you just may be starting out in a career. And then in the future, either refinance into a fixed rate or let that rate go up on the adjustable, and you'll be able to weather the storm because you'll be making more money. So that's one. The other thing is what I just kind of alluded to with the initial lower payment. When you're getting a home, you use that loan just initially to get that low payment, knowing that it's going to possibly go up or you're going to need to refinance in the future. So that's a great one. And combining a adjustable refinance with a cash out refinance can really be a 1-2 punch, great strategy to use, because as we've talked about, on a cash out refinance, a lot of the time you might be improving your home, increasing the value. Maybe you're paying off debt, protecting and building your credit. So an adjustable rate there can be like just an initial teaser or something that you'll keep for a short period of time, just until the credit is where it needs to be or your home value goes up or whatever issue is plaguing you is out of the way, which usually can be done in just a couple years or less. Then you can refinance into that longer term fixed rate program, whether it's a 15-year, 20-year, or 30-year fixed rate mortgage. So that can be a really great refinancing strategy, is combining the debt consolidation or the cash out with an adjustable rate, almost like a Band-Aid loan, as we've talked about in other shows. But one thing I want to caution people about when it comes to refinancing with an adjustable rate is you don't want to wait until the time clock is up to go and look at refinancing. What most people say is, oh yeah, I've got an adjustable rate, but it doesn't expire for 2 years. So I'm not going to look at refinancing now. Why would I? I've got this rate for another 2 years. The issue is that you're at the mercy of the market. If you wait until that expiration date and you start looking at refinancing right then or within a month or two, whatever the going rate is, whatever the housing market is, whatever your credit is, whatever your income is, we don't have any flexibility. It is what it is, and you have to take the hand you're dealt. Whereas if you deal with a mortgage advisor or someone that's managing this and helping you through this, they're going to be able to sniff out an opportunity maybe a year ahead, a couple years ahead. I've had people take a 5-year or 7-year adjustable rate and refinance 2 years in because they can get such a good deal at that time. Nobody says you have to keep it for the entire amount of time. It used to be different. There used to be penalties in the state of Connecticut when it came to refinancing out of these. Those penalties are gone now. They've been outlawed. That was a reason why people wouldn't refinance it, because they'd have to pay thousands of dollars in penalties if they got out early. Now that's illegal. It cannot be offered, those prepayment penalties on conventional or FHA loans. Those are not available anymore. They were outlawed. So you don't have to worry anymore about that. And you can take a 5-year, 7-year, 10-year loan, like we're saying, and you don't have to wait. You can get out of it in 2 years. The home value goes up. The rates are down. Get out of it now. I've seen people that had a 2.9% adjustable. Now they can get a 2.8% fixed. Why wouldn't you, right?
Wow. Common sense, actually. Folks, you're listening to Mortgage Matters Radio Show with Rob Weinberg. You can reach him at mortgagemattersradioshow@gmail.com. He's also got a great phone number, 860-413-3938. I say great because it's easy to remember. 860-413-3938. I'm Gary Byron. What does the future look like for adjustable rate mortgages?
So I think as we continue to see the housing market really boom and we continue to see interest rates slowly but surely move in the upward direction, which we haven't seen in so long, I think that these adjustable rate programs are going to become a lot more useful. And I think they're going to become just a lot more part of mortgage financing and different options that you can look at. Because again, if you're paying more for a house, you need to cut corners somewhere else. How can we get that lower monthly payment? And an adjustable rate can be a great way to do that. And as the rates go up on the fixed rates and adjustable rates decrease, I think there's going to be a bigger gap. Whereas now, there's not a big gap. Like I was saying, maybe 1/8 of a point, 1/4 of a point, it's not worth the risk. But if I can get you an adjustable rate for 3/4 of a point or a full percentage point lower, which is the way it used to be, it's very attractive. Again, if I say to you, your fixed rate mortgage is $1,500 a month, your adjustable mortgage is $1,300 a month, it becomes a lot more enticing, wouldn't you say?
Oh, yeah. Yeah.
So I think that's what we're going to see really over the next couple of years. We're going to see the return of these adjustable rate mortgages. There's also a type of mortgage through an adjustable called an interest only, where you can even get a lower payment by just being required to pay the interest each month. It can be dangerous, but for somebody that understands money, finance, and has a fluctuating income, an interest-only adjustable rate mortgage, it used to be all the rage because it was several $100s a month, less than the full adjustable rate or the normal fully amortizing adjustable rate. So I think we're going to see the return of some of those quote-unquote exotic loan programs, maybe not as risky as they were years ago, because, again, those were outlawed, but some of them we're starting to see rumblings that they're coming back, and I think the interest-only combined with adjustable rate is one that I would be surprised if we don't see in the next couple years make a comeback.
Who are the types of people who could most benefit from adjustable rate mortgages?
So like I was saying a few minutes ago when we talked about refinancing strategies, I think the number one type of person that's perfect for an adjustable rate mortgage is a young professional or somebody that's starting a professional career that knows over the next 3, 5, 10 years, their income is going to increase. Again, a lot of young doctors starting out, attorneys, and other really high-income professionals, they might start out only making 40, 50, 60,000 their first few years. But after 3 to 5 years, they could be pulling in 6 figures or multiple 6 figures. That's like the perfect person to be looking at an adjustable rate, because once the rate does adjust or you need to refinance, you're going to have a stronger financial picture. So that's going to be a great person. The other really common use and type of person that would want to look at an adjustable rate is if you know you're only going to be in your house for a certain amount of time. You know for a fact you're going to be only keeping a house for 3 years. Well, then who cares about getting a 30-year fixed mortgage? Let's get you maybe a 5-year adjustable rate. Build in a little bit of risk aversion there, because if you know you're going to be out in 3 years and we give you a fixed rate for 5 years, then even if you're out in 4, you still are able to accomplish that financial goal. Where it gets sticky is if you think you're going to be out in 3 years and then you end up being there for 10. That's where it can be risky. But I'd say the most common use of that would be like somebody downsizing their house, like a college kid leaving, and then you're going to get a smaller property, you're going to move, that sort of thing. If there's a life event that's going to happen, of course, nobody can predict a divorce, But if you're needing to refinance or buy a home and you think that could be on the horizon, then typically a house is involved in the divorce. An adjustable rate could be a good option because, again, it's a life event that's going to happen where you know you're going to need to sell or refinance out of that property. Why pay more interest than you need to? The average mortgage in the United States, the last time I checked, was somewhere around 4 years, which means that within a 4-year period, somebody is either selling their home or refinancing. So that's the argument of why take a 30-year fixed mortgage if statistically you're not going to keep that mortgage for more than 4 to 5 years. And the last type of person I would say is going to benefit most from the adjustable rate mortgage is the person that is looking for the lowest payment possible. And that's all they care about is getting that bottom dollar payment. The adjustable rate, with all its pluses and minuses, that's a huge part of it. Is it's going to get you that lower monthly payment that you're really seeking out. So that's something that you want to ask about. And if your mortgage advisor isn't talking to you about an adjustable rate mortgage, because many don't, because of the reasons we've talked about and the disadvantages and the little bit of taboo that's out there about it, ask them about it. Not all banks offer adjustable rate mortgages. You were asking about, do they offer adjustable with the fixed? Some offer fixed with no adjustable. I've seen that quite a bit. But usually if they offer adjustable, they also offer fixed. And just compare your options. Look at, is the risk worth the reward when it comes to these adjustable rates? Is it something that is going to give you enough benefit to take on that added risk if your financial circumstance doesn't play out the way that you think that it will? And I think another thing to consider is that when it comes to an adjustable rate mortgage, you need to financially plan for the future. It's not a one-size-fits-all type of loan, and it's not the type of loan that you can just take it and set it and forget it. It's the type of mortgage that's going to require a little bit more professional financial planning behind it. Like I've said a few times, it's going to require a real mortgage advisor because they're not only getting you into the loan, they also have to get you out of that loan, into that next mortgage, into that next property or whatever it may be.
Outstanding material. Folks, if you are interested in this topic with adjustable rate mortgages or any other, please contact Rob Weinberg at Mortgage Matters Radio Show at gmail.com. Once again, Mortgage Matters Radio Show at gmail.com. Start with his website. That's pretty darn simple as well. www.robgw.com. Once again, robgw.com. And his phone number, 860-413-3938. Again, 860-413-3938. For Rob Weinberg, I'm Gary Byron. Until next Saturday morning, have a good one, everybody. So long.